SCHD ETF has been struggling to find its footing over the last year or so. And this is of course due to the ETF's holding breakdown and the lack of love the market has shown some of these more value stocks that make up the ETF. But there are still some good reasons to think that SCHD could continue to beat the market like it's done on multiple time frames. And in this video, we are going to go over 3 reasons on why I think it's worth smash buying this ETF now. Now, this is especially for investors that are looking for something with a nice starting dividend yield, ETF price return potential, and also have a longer time horizon ahead of them. Now, stick around because we do have a lot to go through. Right after you, please drop a like on this video and subscribe for more future content like this. Now, before we dig into these 3 reasons that I have on why I think SCHD is a massive buying opportunity, let's head over to the Schwab website and learn a little bit of the basics of what the ETF is and, of course, what it has to offer. So for those that might not be aware, SCHD, the Schwab US Dividend Equity ETF, is one of the most popular dividend growth ETFs that's ran by Charles Schwab. Now, this ETF strategy and objective is pretty straightforward. The investment seeks to track as closely as possible, before fees and expenses, the total return of the Dow Jones US Dividend 100 Index. To pursue its goal, the fund generally invests in stocks that are included in this index. The index is designed to measure the performance of high dividend yielding stocks issued by US companies that have a record of consistently paying dividends, selected for fundamental strength relative to their peers. Based on financial ratios, the fund will invest at least 90% of its net assets into stocks. Now, some more highlights about this ETF: a straightforward, low-cost fund offering potential tax efficiency. The fund can serve as part of the core or complement in a diversified portfolio. Tracks an index focused on quality and sustainable dividends, and invests in stocks selected for fundamental strength relative to its peers based on financial ratios. Reason number 1 on why I think SCHD is still worth looking into or even buying at these levels is because of the ETF's amazing screening process on how they either let stocks into the ETF or of course kick them out. Now, to explain more of what I mean, let's dig a little bit deeper into exactly how the SCHD ETF screens for stocks to either be granted entry into the index or of course be kicked out. Now, because SCHD does track the Dow Jones 100 Index, the index universe is defined as the constituents of the Dow Jones US Broad Stock Market Index, excluding REITs. So even though REITs are great, I'm a huge fan of REITs, they are not going to be included into this index. It then says stocks must pass the following screens: minimum 10 consecutive years of dividend payments, minimum FMC of US 500 million, minimum 3-month abbvie of $2 million US. Stocks passing all 3 screens are ranked in descending order by IAD yield, defined as the stock's IAD, not including any special dividends, divided by its price. The top half of securities based on its rankings are eligible for stock selection. The reference date for dividend payments history is the last business day of December, while FMC and abbvie are as of the last business day of February. Now, the index construction, also very important. Constituent selection is as follows. The eligible securities are ranked by each of 4 fundamental base characteristics. Things like free cash flow to total debt, annual net cash flow from operating activities divided by total debt. Companies with 0 total debt are ranked first. Then return on equity, annual net income divided by total shareholder equity. Then IAD yield, and then 5-year dividend growth rate, defined as this equation below. It then says the 4 rankings are equal weighted to create a composite score, and the eligible securities are ranked based on the composite score. The top 100 ranked stocks by the composite scores are selected to the index, subject to the following buffer rules that favor current constituents during the annual review, which are the constituent stocks will remain in the index as long as they are among the top 200 rankings by the composite scores. So even if a stock doesn't rank as high, as long as it's already in the index, it could still stay. Non-constituent stocks are added to the index based on their rankings until the constituent count reaches 100. If 2 non-constituents have the same composite score, the non-constituent with the higher dividend yield will be selected. And then as far as the weighting goes, it's pretty simple. It says stocks in the index are weighted quarterly, based on a capped FMC weighted approach. No single stock can represent more than 4% of the index, and no single global industry classification standard sector can represent more than 25% of the index, as measured at the time of index construction, annual rebalancing, and quarterly updates. Now, reason number 2 that this ETF, in my opinion, is a buying opportunity as of right now is because of the ETF's dividend and, of course, the dividend growth. Now, as of right now, if investors want to get into this ETF, they're looking at a trailing 12-month dividend yield of around 3.5%, which is not bad at all. especially considering there is growth potential in this ETF, and that's pretty much all it's done over the last 12 or so years. But to dig a little bit deeper into the ETF and why I think this is an opportunity. Investors buying today getting a starting dividend yield of around 3 to 4% and trailing 12-month dividend growth of over 7%, with a 10-year growth average being over 11%. Dividend growth investors over time that have bought into this ETF have seen nothing more than consistent bigger and bigger dividends over time. And especially for dividend growth focused investors like myself, this is very important because this is going to juice my portfolio's overall dividends over the next 10, 20, 30 years without me having to do a single thing, without me having to buy a single share or even think too hard about the portfolio overall. The portfolio will continue, at least historically it has, to pay me more and more in dividends over time. Now, reason number 3, the last reason on why I think that the Schwab US Dividend Equity ETF, SCHD, is a massive buying opportunity is because of the holding breakdown and the value that these sectors really offer. Now, like we kind of touched on earlier, this ETF does have a very specific method on how to pick the stocks within the ETF's holdings. The current holding breakdown is industrials at 18%, healthcare at just over 16%, financials at almost 15%, consumer defensive at 12.6%, technology at 12.14%, energy at 9.6%, consumer cyclical at 9.5%, communication at 4.3%, basic material just under 2%, utilities and cash just under 1%. Now, this fund normally holds just around 100 different stocks within its basket of stocks, and the stocks within this portfolio are going to change on a consistent basis, normally once a year. But the top 10 holdings as of right now for SCHD are companies like Amgen, Cisco, abbvie, the Home Depot, Broadcom, Coca-Cola, Merck, Chevron, UPS, and Pepsi. Now again, all the companies within SCHD do pay a nice solid dividend, and on top of that, a lot of the companies have some pretty impressive dividend growth. You see, a lot of the top sectors in SCHD have not got a lot of love throughout the markets over the last year or so. But that's not exactly the case historically speaking, especially after the new year when SCHD undergoes its next reconstitution and we do see some more stocks get shifted in and out of this ETF. I think that there is huge value potential for investors that are willing to weather the storm, because once these sectors turn around and get some more love, and once the new top 10 holdings are more favorable for some bigger growth, this ETF share price could be once again off to the races, heading towards a new all-time high. So there we have it. Those are just 3 reasons on why I think the SCHD ETF is a smash buy opportunity for investors looking for a nice starting dividend yield, capital appreciation potential, and of course for investors that have a longer time horizon ahead of them. But I want to hear from you guys down below when it comes to SCHD. What is the number 1 component as far as what this ETF is offering as of right now that makes it a buy signal for you? Comment down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.